Well, hello and a very warm welcome to this Corporate Outlook webinar brought to you by Scope Ratings. My name is Keith Mullin and it's my pleasure to be your moderator today. I'm delighted to have with me on the session Scope's co-heads of corporate ratings. So let me introduce you straight away to Sebastian Zank and Karl Pettersen. Gentlemen, it's great to see you. Thanks so much for your time today. Now, this year's Outlook is subtitled With Eyes Wide Open, which hints at caution. Why? Well, on the one hand, we've got a fairly resilient economy, buoyant stock markets, super tight credit spreads, and blistering levels of debt issuance. On the other hand, default indicators, business and consumer confidence, and underlying credit quality paint a more nuanced picture. And then you have to factor in some of the structural changes taking root across politics, trade, technology, and finance, just when Europe is seeking urgently to fortify its economic, financial, defense, and energy security. Now, how all of that intersects to affect European corporate credit quality is complex, which is why I'm so pleased to have Sebastian and Karl on the session today, because I'm going to be asking them to offer their thoughts about what to look out for this year. Now, we did publish our corporate outlook already, which for convenience will be made available for download at the end of the session today. But we wanted to do a live session as part of a market outreach, but also to take your questions. So please type these in as we go along and we'll get to them in due course. Now, we've decided to do this rather than a long presentation. We split it into a more, a Q&A style conversation to make it a bit more interactive. So I'll be asking questions and Karl and Sebastian will be answering, supported by a small number of slides. So that's it from me. Gentlemen, let's get right to it. And I'm going to start with you, Sebastian, if I may. I mentioned a whole bunch of macro factors here. In terms of where we are today, I think it's a good starting point. Can you kick us off by defining where we are today, perhaps through the lens of the corporate ratings?
Yeah, many thanks, Keith. I'm delighted to give you a little bit of a background, and I'd like to start with an overview or a snapshot of our ratings development that we saw in 2025 and the situation with which we started in 2026. So when we look back at the ratings development of our coverage, which roughly comprises 300 different non-European European corporates, we see that the picture in 2025 was already anything but straightforward. And in fact, the picture has shown a distinctively two-sided story or two-sided picture. So on the one hand, and Keith, you've mentioned already some of the points which played a crucial role. We saw that the macro environment was continuously improving despite all the geopolitical disruptions. But at the very same time, we also saw that the vulnerabilities that we face in Europe have strongly affected the overall corporates landscape. To be a bit clearer, when we look at this credit supportive side, which is clearly the macro environment, we have seen so many indicators for 2025, but then also for the next few years, which show a widely supportive picture for non-financial corporates. So be it the improving consumer and business confidence or the moderating inflation. Also, supply chain disruptions have normalized a little bit. And so this is certainly an environment which is supportive for many companies that take the opportunity to shore up their balance sheets, being very disciplined about their cash flow profiles and take all the measures to stabilize or even improve their credit profiles. So That's the positive news. But on the other hand, we also saw some other developments, and this was and still is a very crucial point, which relates to credit risk against this supportive macroeconomic backdrop. Because we have clearly seen that despite the rather supportive macroeconomic environment, the default rates and likewise the credit risk overall did not reduce overall. So we have still seen continuously rising numbers of corporate defaults across the continent. Certainly there were some countries where default rates were moderating, but still in the big economies like Germany or France, for example, we've just seen record high numbers on corporate defaults in 2025. And likewise, we've also seen a continuously rising amount of non-performing loans, which certainly signals a completely different picture. So yeah, what does this mean? We think that this situation shows that not all the companies across the continent are benefiting from the macroeconomic environment in the very same fashion, and that overall the credit risks and particularly the default risks remain elevated. Particularly among the smaller players in the market and naturally among the high yield credits. So this duality of these opposing impressions was also very visible in our ratings development. So when you take a look at the picture on the left-hand side, where we've split the ratings development between investment grade rated credits and high yield credits, there you clearly see that the investment grade rated credits basically were largely supported by the macroeconomic backdrop. And the companies have certainly shown some very stable rating or credit development. And this group of company often dominates the public narrative about credit risk. But then when you look at the other side of the coin, then you see that for the high yield credits, there is much different development. And this is basically the area where the systematic default risk lies, because that's naturally concentrated among the smaller credits of companies and those which already carry a high leverage that they need to face over the next few years. So these smaller companies and these high yield companies, they certainly have faced and they are still facing a different reality. And from our perspective, those companies shape the overall market dynamic, which would then be the basis for our outlook in 2026. And this clearly reveals that the corporate landscape or corporate ratings landscape is not so aligned with the macroeconomic trend, because what matters more is the structural developments, which can then shape primarily to the negative side the creditworthiness of the sector. And overall, as a result, we have already entered 2026 with an outlook which is somewhat tilted towards the negative side. So when you look at this little donut chart on the right-hand side, where I've shown the outlook distributions among high yield credits and investment grade credits, there you can already see that there is still a large number or a significant number of high yield credits which are accompanied by a negative outlook. So roughly 25% of our entire ratings spectrum carries this outlook, and that is is definitely then something which we are very mindful and which overall shapes our slightly negatively tilted outlook for 2026.
Good. Thank you very much for that, Sebastian. Some great insights there. Karl, let me hand the baton to you. Given what Sebastian just mentioned in terms of where we stand today, and I guess I referenced a whole bunch of topics at the beginning, can you perhaps talk about the direction you see some of the trends that have been mentioned in 2026? And I guess perhaps more importantly, not just the direction, but why?
Certainly. Yes, thank you, Keith, and hope you can all hear me okay. The quick answer to your question is this duality that Sebastian just mentioned in terms of credit risk, this duality also to some degree in market narratives. We expect the duality to become more pronounced as the year goes on. And this is largely because we are facing a number of very significant structural shifts in the market that Sebastian had alluded to, and which will exacerbate, I think, a lot of the existing vulnerabilities that we see today. And it's not so much that the goalposts are moving today. It runs deeper than that. It's more some of the foundations are shifting. So one way to think about it is how these movements will translate to credit risk in 2026 is that not only they will add volatility, but they also risk interfering with traditional cycles, right? And this means that traditional market indicators, their significance may be disrupted, may be potentially harder to interpret. And that's maybe what we're seeing in a little bit of this duality in market narratives at the moment. But what we do know is these shifts are vast, they're new, and quite frankly, can be a challenge for market participants to incorporate them today, simply because we've never priced them before to that extent. We've never had to. But they are systemic in scale, and their early effects are already very significant. So perhaps to make it a little bit more specific, in the context of our outlook, we focused on four major topics that we think will shape the landscape and how they're likely to intersect with more traditional credit drivers and credit analysis. This slide here is a little bit of a schematic, but I certainly encourage you all to read the outlook where we've tried to bring out some of these narrative themes. So these four major topics, the first one is geopolitical realities, and these are already manifesting at the level of individual European issuers in ways that are very tangible and that are sometimes abrupt. And let's also be very clear here. I think every profession has a tendency to be a little bit reductive sometimes in their worldview. I think that's just human nature. So it can be seductive in the financial community to think of geopolitics as a little bit distinct from the day-to-day funding needs of a mid-cap manufacturer, for example. But that's not really the case, because the geopolitical environment is foundational to corporates. It defines returns, therefore it defines capital flows, therefore it defines liquidity and credit. So what we're seeing today, just on the geopolitical side, is for many European issuers, it already means structurally higher costs in Europe, which erodes competitiveness. It means a need to rethink large supply chains, rethink capital allocation philosophies in many ways, even how you invest in your physical asset base. Basically, it's a new world, right? And so past habits of risk return may just not work as well as they used to. This then extends into rapid changes in the competitive landscape. We're seeing a surge of import competition, notably from China, across a number of European sectors. And all this at a time where global markets and price signals are more interconnected than ever, which can lead to unpredictability in transmission mechanisms of risk, and essentially an environment where just on the geopolitical front, it's more costs, more competition, less certain returns, and demand that, to Sebastian's point, is a lot better than what it used to, but it's still a little bit muted. So that's one thing. Secondly, everybody's talking about AI. And certainly that has created unprecedented equity valuations and investment, but that has also come with unprecedented concentrations of value. And this becomes relevant to credit because it affects market liquidity. It provides investors with added confidence around the market's capacity to absorb and to disperse loss. And certainly, a rising tide lifts all boats. But the cash flow returns from these investments, and these returns are what will actually support credit quality, remain largely untested at this point. So here the risk becomes twofold. It's the potential for a market correction that will undeniably have knock-on effects, especially given where market prices and yields are today. And also then disruptions to business profiles that nobody really knows how to predict today. And the risk here, coming back to the bifurcation and the duality that Sebastian was just describing, is that these types of change will likely disproportionately impact issuers who have less adaptation capacity, whether that's in their business or their financial risk profiles, i.e., on average, most likely those that are lower rated already. Beyond that, two other changes to mention. One is that credit markets are being transformed at scale and at a fundamental level, in no small part through the continued growth in private credit, which serves to magnify current market narratives of historically tight spreads and very abundant liquidity, but also simultaneously introduces growing opacity in the market. And this opacity is rising at a time that we also see simultaneously creditor protections being eroded. So creditors are being pushed to take on more equity risk increasingly, and in a way that becomes really less and less observable by market participants. So liquidity is increased, but downside risk is also increasing, and the signals of this risk are less and less easy to read at the moment. And then finally, Keith, you were mentioning this in your opening comments as well. Europe faces massive needs for capital and security at the moment, whether it's in energy and defense or in trade, which will intersect with these trends above, sometimes will exacerbate them, and also at a scale where at some point compromises probably need to be made, and the private sector will probably need to be asked to carry a part of the cost and the risk. So these four factors, they coexist, they will intersect, and in ways that can really exacerbate each other. So it's not difficult to imagine a scenario where you have, say, private equity-backed companies that are more tech-heavy currently, not at the hyperscaler level, potentially prone to disruptions with creditor protections that may have that may make us lean more into equity risk and layers of interconnectedness that we can't really see. So part of the risk there is that diversification on paper may not really be diversification in reality. And with this, just finally, and I'll hand it back to you, but to put it back in a default context as well, and back to what Sebastian was saying, where defaults are often driven by liquidity events, it's worth keeping that abundant market liquidity can serve to postpone, can serve to dispel potential default scenarios, but it can also serve to mask growing credit stress in some cases, and that is until it can't anymore. For example, if there's a shock in the foundation. So I hope that gives at least some picture.
Good. Thanks, Karl. In fact, Sebastian, when Karl just started speaking, we did have a question come in, which I perhaps would have asked you before the previous segment. But I guess it could also kind of like feed into the question I was going to ask anyway. And the question is this: it says, given the widening gap between higher and lower rated issuers, what signals will show that the bifurcation is becoming systemic? I mean, do you have any? I mean, that's, I guess, systemic, however you define that. But do you have any kind of immediate kind of thoughts about that? Systemic, I'm assuming, means that it's more than idiosyncratic.
Yeah, we certainly have some indicators that signal this systemic risk. So I think that can be boiled down to also these points that Karl mentioned, and some overarching topics which are the reality of European companies. So maybe I can answer this question with a little reference to different sectors, and our view how these systemic risks can trickle through to these sectors. So we certainly can assume that all those challenges that we have shown here on the left-hand side are affecting different sectors in a different pace, in a different yeah, altitude or amplitude. So as we are dealing with a very heterogeneous set of sectors, which all have their different sector fundamentals, one needs to determine this on a case-by-case basis. And here I maybe want to recommend to read some of our sector outlooks or the sector commentaries that we have pushed out over the last few weeks, because they are then detailing the views about these sector disruptions and the protective measures certain companies are taking in order to weather those storms. But when we boil it down to then I think we can signal three major topics which then differentiate the good from the not so good companies, and which will then result in this bifurcation of the market into the companies that can deal with those difficulties, and those companies which will face some increasing problems over the next few years. So one could certainly look at the companies' overall positions in the market and their overall competitiveness. Something that, of course, cannot be measured through very quantitative assessment points. It's something that rating agency assesses rather qualitatively, but there are so many signals which we can take into account, which show a structural erosion of a company's competitiveness or a company's good ability to face these challenges. So here we are looking at factors like whether the companies can deal with structurally higher costs, which are just a reality for many companies. And we already see which companies can exert their pricing power and which companies can't do it. We see that some companies will be challenged tremendously over the next few years because they are confronted with a heightened degree of competition that comes from imports. So the primary market that challenges European companies is certainly China, where we see a number of sectors which have to deal with the massive inflows of goods that are naturally coming from China into Europe, or which also have to be rerouted from previous supply channels, like, for example, to the US. So there we certainly make this distinction between companies that have an answer and an ability to adapt to this new reality, and companies which simply don't have the financial means to react, and who then have to live with the consequences, which naturally could affect their credit profiles. And we also see challenges for eroding competitive positionings stemming from disruptive supply chains or simply technological disruptions that some companies can weather and some other companies cannot weather. So it's very important to assume that things are not continuing as they used to develop over the last few years. So with all this mix of new challenges, it's pretty important to have an ongoing monitoring about companies and their competitive edges in order to determine the wheat from the chaff overall. The second,
Indeed.
yeah.
No, carry on.
Yeah, the second point that we can use in order to see where companies are separated is a look at the capital allocations of those companies. So Karl has already mentioned this big topic of the heightened need for capital. And it's not just related to this very hot topic here in Europe, which is defense. Capital allocations affect a number of sectors where sometimes we see new topics arising, but sometimes we also see that CapEx phases, which have already been initiated a few years, are now accelerated, or they need to be accelerated in order to remain competitive. And that is then certainly something that also some companies can well handle. So typically the larger, the investment grade rated companies that have an undisputed access to external funding can certainly deal much, much better with these challenges than other companies in the high yield space, which are already quite indebted and which might not be able to invest in very important areas in order to stay competitive. A look at cash flow profiles is very important with this accelerated investment cycles. So we see, for example, utilities, oil and gas companies, or automotive companies, chemicals companies that certainly need to do more than they used to do over the last few years in order to keep their position. But as the returns from all these investments are just coming in a few years, one needs to be very mindful how this mismatch of cash inflows and cash outflows then affects the credit profiles of these companies. And on that front, it's not super easy to determine which companies will lose and which companies will win. But based on the cash flow profiles and the expectations, how quickly these investments are then settling in with increased returns is something that indicates to us which companies are keeping their credit profile or improving it even, and which companies are losing out in the medium term.
Right.
Yeah, and the final point would be the access to external funding, where we also see this bifurcation and a reality in Europe that we've witnessed over the past few years, where things can change very quickly. So some of these challenges are structural, where deterioration to external funding can become systemic. So, for example, in the area of real estate, we have seen that in 2022 to 2023-4, market access was quite constrained. Then the market has opened up very nicely for real estate companies in general. But we already see that there is a systemic change because the smaller companies do not have the very same access to external funding any longer, although the overall environment is quite buoyant. So they still get access to external funding, but it comes at the cost of secured loans that they need to take on board in a more pronounced fashion than maybe before 2022. Yeah, and this is something that certainly affects those companies, because at a certain point there is a limit to their overall debt profile. So typically the lower rated companies would face that challenge, while the good investment grade rated names would not be confronted with this challenge. Yeah? And there you then also see a widening between the good and the bad companies in the market. Or another topic, and Karl has also quickly touched on it, is the private debt market, where just small disruptions in the market can already lead to a completely different perception of investors. So while overall the sentiment for private debt is still quite good, we've seen last year with these defaults, First Brands and Tricolor, that there was an immediately changed perception on whether one should support this private debt segment much further or not. And as this sector is already exposed to highly levered companies, that's the natural group of companies which require private debt. You can imagine that if this continues over a prolonged period, it could determine the death of many companies which are already at the brink to insolvency in that particular market segment. So just small changes can really distort the market at the lower end of the credit spectrum, while the higher end of the rating scale can well manage that, even if it's a systemic change.
Yeah. Good. Okay. Thanks, Sebastian. I've got a quick definitional question that's just come in. When you guys talk about medium term, are you talking 1 to 2 years, 3 years, longer? Can you just kind of just to help our viewer put a bit of a time frame around the terminology?
Well, we can be very technical, or we can be very artsy about it. I think
Philosophical.
Let's perhaps the nice intersection between the two is to say 12, 13 months tends to be short term, and then anything I would personally view it as 24, 36 months, but obviously it depends on where you are in the rating scale as well, right? And what kind of predictability you can have. But I think that's not a bad guideline.
Okay, good. So Karl, look, I wanted to reference back to this tagline, which is a kind of fascinating tagline, eyes wide open. Bearing in mind what you and Sebastian have said to this point, what does this mean actually in practice? You bring it into clear focus, but what does it mean in practice for market participants actually, and for scope analysts on a day-to-day basis? Because we're entering a kind of a bit of a new paradigm here.
Yes, indeed, and exactly this. There are new elements to the paradigm. There's a number of moving pieces, and we've covered a bunch of them already. But I think what we tried to do in the outlook is also to distill it to some real essentials, and the essentials of what it means to have eyes wide open as all these moving parts are shifting. And I think one thing to keep in mind here is that credit analysis and credit ratings are powerful because they're anchored in unwavering analytical principles, right? And so I think as we go into 2026, this is the time to double down on these analytical anchors. So I've listed the 3 that are here that we go into some amount of detail in the outlook, and again, encourage everybody to read through them. But perhaps the first one is to not confuse structural and cyclical changes. Very simply put, one of them will rebound, the other will not. And that gets us to the question of, is it short term, is it medium term? This means that we should make sure we don't confuse short-term market opportunity, for example, with long-term credit worthiness. They're 2 very different constructs. A number of these structural shifts are here to stay, I think, beyond 2026. And they're also accelerating at the moment. That means that where they're likely to accentuate risk, that risk will be lasting, will need to be priced by the markets, and somebody will need to pay for it at some point. So make sure that you understand all the vulnerabilities in your credit profile independently from what the market is telling you today, right? Another way to think about it is also beware of magical thinking, frankly. If it seems too good to be true, we're in the business of assigning likelihoods and probabilities, so to speak. If it's too good to be true, the likelihood tends to be that it probably is, right? So with all this, credit, one way of thinking about credit is also that it's ultimately about making sure that assets and liabilities are adequately and robustly matched together. And in this kind of matching, cash is king, not market indicators, not credit ratios. So make sure you understand these mechanisms of transmission and how these risks will manifest in your credit, not what some market ratio tells you. So that's one. Secondly, I think we've made it very clear that we should expect this ratings bifurcation to increase. We're already seeing early signs of winners and losers. Sometimes it can still be difficult to discern for reasons that Sebastian has just covered, for example. These will be driven by multiple forces, right? It can be cost, returns, supply, demand, liquidity, access. And in this, the devil is in the detail. So understanding your business risk profiles in detail is absolutely critical. And that means understanding exactly what market dynamics each company faces, how this company fits into these dynamics, who their competition is, on what basis they compete. So is it technological basis? Is it an economic basis? Is it a regulatory basis? Is this market being redefined as we speak? And once again, if you're not sure, there's a lot of value in being cautious. And one thing I think it's always worth reminding people of is, that level of caution makes sense in credit analysis, because at any rating that you have, there's a myriad paths to default, but the path to the other end of the rating scale, AAA, is a lot narrower, right? So uncertainty increases risk increases geometrically. Make sure you understand where risk lives in the business of your company, and make sure you know exactly how to think about it. And finally, here we entitled the box New World, New Rules. The foundations might be changing, but credit principles don't change. Capital allocation, we were just talking about that, generates returns. Returns is one of the foundational pieces of credit quality. And confidence in these returns ultimately also drives creditor support and market liquidity. So where market liquidity is very enthusiastic, it can create allowances for lower returns or less certain returns. But in the end, if the math doesn't math, then it goes back to fundamentals very quickly. And that means cash flow. That also means creditor protections. And certainly from my perspective, eroding credit protections is always a negative for creditors, because it transfers increasing layers of equity risk onto creditors. We see this happening as we speak. So make sure to incorporate this fully and immediately. And then finally, as we're talking geopolitics and all these factors, ultimately we're also talking about price signals that may move in strange ways. So the price signals on your costs might be elevated. The price signals on your product might lower because of competitiveness. So it's important, once again, tying it back to business risk profile, once again, tying it back to structural versus cyclical, to know exactly why these move. And if we don't know today, to have, a clear upside and downside, and clearly understood transmission pathways of how these price signals convert into credit quality, and clear triggers for action as well. So, to your point, it can be a bit nebulous. The paradigm is shifting. That means the actual data may still be emergent, but the more clearly you can define mechanisms of transmission of credit value and credit risk using, solid credit principles, the more you'll be able to process information quickly when it arrives, and the more you'll be able to accurately respond. So, these are always foundational principles in credit analysis, but I think more than ever in 2026, this is the time to really double down on these principles right now.
Indeed, one of the fascinating topics, just thinking about what you were saying, and you actually said, obviously correctly, that the market's got to price in these factors, but the interactions are quite nebulous, as you said also. So are you implying that the markets are currently mispricing risk?
Excellent question. And just to make things perfectly clear, we're not in the business of commenting on whether market prices are too high or too low. I think where we can interpret the price signals is to say that these structural shifts that we're seeing are large enough at the moment and are moving fast enough at the moment that they're difficult to project, right? They're difficult to forecast. And we all know most forecasts anyway necessarily have a margin for error, but you're seeing many divided opinions on the topic. You're seeing ranges of outcomes, and that tells you that there's probably a similar range of confidence in where prices are at the moment. And I think just the fact that we're seeing some of this duality at the moment and this bifurcation, including spreads that are very tight at the moment, and scope institutionally, I believe we have commented on the fact that it seems to suggest there's limited margin for error in pricing today, and limited scope for highly developing medium-term risks. Just the fact that these trends are difficult to project means that they're difficult to price. So whether things are mispriced or not today, time will tell, right? But I think it's fair to say that it's a more difficult exercise today than probably it's been in a long time. So eyes wide open.
Yeah, absolutely. It's a very reasonable response. So look, we're kind of at the end of our time here. And so unless our viewers, well, if you've got more questions, put them in now, because we'll end in a moment. But in the absence of questions, we wanted to thank you both, Sebastian and Karl, for tackling some pretty kind of open-ended, broad, blue sky topics. I think with some incredibly insightful pointers. Thank you to our viewers for joining and staying till the bitter end. Hope you find that useful. If you have any further questions, please don't hesitate to reach out to Karl, Sebastian, or myself for that matter, and we will always be willing to get back to you with answers to more questions. I did say that the corporate outlook will be made downloadable, and the technical gods are on our side, because hopefully you'll see a pop-up on your screen to download the outlook, and so I'll give you a second to do that. But bearing in mind everything we said today and on previous topics in webinars, we are entering uncertain times with a whole bunch of new topics, themes, and factors that whose interactions are as yet unknown or evolving. So depending on the topic and how things evolve, we will certainly be back for more sessions as they become appropriate. So on that basis, final thank you again from me to Sebastian and Karl, and to our viewers, and we will see you next time. So be careful out there.
Thank you, everybody. Appreciate it.
Thank you very much.